Well, let's talk about a latest strategy report that's coming in from none other than Vikash Kumar Jain of CLSA. He, of course, is the recent strategist, and he has been looking in at earnings on one side as well as high frequency data that he's looking at. So he's looked at a total of 46 high frequency indicators which have come in of late and compared them to the last 3 months averages. So, of course, they have divided into two parts. One, of course, is the industrial part of it, and second, of course, is the consumption part of it. So what they are saying is that nearly 40% of the 46 high frequency data that they show registered a YOY decline as far as Jan 2021 is concerned, versus a smaller one-third number that was showing a YOY expansion. This suggests that the economic recovery or the pace of economic recovery which is actually happening in the markets or in the GDP is something which is actually slowing down, and that, according to them, is something which one needs to track. Now, trends in the industrial indicators were mixed as far as proportion of rising to the falling names, staying flat or equally divided, or one can also say that one-third each is what they could look at. Alarming was more than the consumption number that fell. So most of the high frequency consumption numbers saw a month-on-month decline. These are early trends for industrial indicators for the month of Feb 21 were weak, while consumption indicators were on the mixed side. So what they are actually suggesting is that a high proportion of economic indicators worsened versus improved. They have also gone ahead and said about their strong and improving data that they are looking at. So they're looking at a holistic picture of 46 data that we're talking about. So banking credit growth, banking deposit growth is looking in good. CPI is looking in good. FDI inflow over the 12 months is looking an encouraging number. New launches, especially in the residential housing, is looking strong. Passenger growth in terms of railway is also looking in on the higher side. You have quarterly sales of residential tariffs that's also looking in on the on the higher side. Passenger growth in terms of airlines is looking in strong. Now, when we talk about weakening and worsening data, what they are saying is that WPI number is looking in weak. It's looking in worse than what it was. Steel consumption, not production. Mind you, production numbers have looked quite encouraging. Growth in credit to service sector ex-NBFC is looking in on the weak side. Auto loan growth is looking in on the weaker side, and individual APE, which is of course the insurance number. The interesting thing to note is from weak to strong, what is looking in. So steel production is looking in good. Diesel demand growth is looking in good. These two are, of course, an indicator as far as macroeconomy is concerned. Cement production is weak but is still improving. You have growth in credit card loans that is still weak, but actually one can say that it's going ahead and improving. So most early industrial indicators for Feb have weakened, including power, demand, railway freight, diesel consumption, registration of CVs, trends in EV bills are also not looking that great, but business linked, high value banking transfer, ATM transfers have all improved on a month-on-month in Feb 2021. Overall, looking in mixed, but for the last few months, you constantly had all the indicators increasing, and that's why it was important for him to highlight this trend that he's seeing across 46 data indicators.